The government is quietly pushing to put private equity and cryptocurrency inside your 401k. That sentence probably either excited you or scared you, and both reactions make sense. This is a real policy shift that could affect every American retirement account. Here's what it actually means for your money. Welcome to Fuel Your Wealth. Let's break it down. Right now, your 401k is limited to pretty conventional investments: mutual funds, index funds, target date funds, maybe a stable value fund. The idea has always been, keep it simple, keep it diversified, keep it liquid. But the Department of Labor under the current administration is signaling a shift. They want to open the door for 401k plans to include alternative investments, specifically private equity funds, and in some proposals, cryptocurrency assets like Bitcoin. This is not a rumor. Several large asset managers have already submitted proposals. Some plans are already running pilot programs. If this moves forward, your retirement menu could look very different within a few years. Here's the case they're making. Private equity has historically outperformed the public stock market over long periods. Institutional investors, pension funds, endowments, sovereign wealth funds have had access to private equity for decades and used it to generate strong long-term returns. Why should billionaires and pension funds have access to those returns but ordinary workers don't? That's the pitch. Democratize access to higher yield alternatives. For Bitcoin, the argument is similar. Over the past decade, Bitcoin has dramatically outperformed nearly every asset class. If a small allocation, say 3 to 5%, had been in your 401k 10 years ago, your balance today would look significantly different. Now, here's where it gets complicated, and where I want you to pay close attention. Private equity funds are illiquid. You can't sell them whenever you want. They typically lock up capital for 5 to 10 years. That's fine for a billion-dollar pension fund. But for a 45-year-old worker who might need to change jobs, roll over their account, or weather a financial emergency, illiquidity is a real problem. The fees are also a concern. Private equity typically charges 2% management fees plus 20% of profits. Compare that to a total market index fund charging 0.03% annually. Fee drag over 30 years is enormous. Cryptocurrency is even more volatile. Bitcoin has dropped 80% or more multiple times in its history. For someone 5 years from retirement, watching half their balance evaporate in a crypto crash is not a theoretical risk. It's happened multiple times. In 2022, the Biden-era Department of Labor warned fiduciaries against offering cryptocurrency in 401k plans, citing excessive speculation. Now the current administration is reversing course. This is not about what's best for your retirement. This is partly about which asset managers have access to billions in new capital. Follow the money before you follow the headline. Here's the practical guidance. If your plan adds alternative investments, don't allocate more than 5% of your total balance to them. Combined, treat it like a speculative sleeve. Keep the core of your 401k, at least 80 to 90%, in low-cost diversified index funds. The boring stuff still wins over 30 years for most people. If crypto or private equity gets added to your plan, read the fee disclosures before opting in. If the fees are more than 1% annually, the math probably doesn't work in your favor. And regardless of what changes, keep contributing. Time in the market with regular contributions in low-cost funds, that is still the single most reliable path to retirement wealth. The 401k is about to get more complicated. Whether that's good or bad for you depends entirely on how you navigate it. Now you know what to watch for. If this video helped you, subscribe to Fuel Your Wealth for more breakdowns like this every week. This is not financial advice. Always consult a qualified professional before making changes to your retirement accounts.